Hey everyone, James here. Welcome back to your James AG. And today's discussion is not about hype, predictions, or chasing candles. It's about system stress, physical reality, and what happens when paper narratives start diverging from real-world supply. Before anything else, we need to get something absolutely clear, because every time volatility enters precious metals, the scams follow. I do not send DMs. I do not ask for money. I do not offer investments, signals, courses, or private groups. If someone is using my name, my logo, or anything that looks like me and asking for payment, that is an impersonator. Block them immediately and report it. No exceptions. This channel exists for analysis and education only. Nothing here is financial advice. I don't manage capital, I don't recommend trades, and I don't tell anyone what to buy or sell. You are responsible for your own decisions and you should verify everything I say independently. Now, with that out of the way, let's talk about why this video matters. Silver is not just another chart. It's not just a speculative asset. It's a strategic input for energy systems, defense, electronics, and industrial infrastructure. And when silver starts behaving abnormally, it's usually not because of retail excitement. It's because something underneath the system is under pressure. Today, we're going to walk through a development that is extremely rare, not because of price alone, but because of who is saying what at the same time, from two completely different sides of the market. But before we do that, I want to pause and talk directly to the community. If you've been here for a while, if you're not here for hype, not here for get-rich-quick narratives, and you actually care about understanding how these systems work, type OG in the comments. That helps surface the real audience and filter out the noise. Also, let me know where you're watching from, country, state, or region. Not for vanity, but because physical metal markets are geographic, and the experience of supply stress is very different depending on where you live. This channel is about mapping those differences, not pretending the world is one uniform market. Now, a quick but important filter. This content is not for day traders looking for a quick hit. It's not for people who need certainty, guarantees, or price targets to feel comfortable. And it's definitely not for anyone who blindly follows personalities instead of data. This channel is for independent thinkers, people who understand risk, who know that volatility cuts both ways, and who are willing to sit with uncomfortable information rather than chase narratives that feel good. Silver especially demands that mindset, because silver lives at the intersection of paper leverage and physical constraint. And when those two collide, the moves can be violent, misleading, and emotionally destabilizing if you don't understand what you're holding and why. In this video, we're going to stay grounded. We're going to distinguish clearly between physical silver, metal that must be mined, refined, shipped, and delivered, and paper silver, futures contracts, derivatives, and claims that exist primarily inside financial plumbing. Those are not the same thing. They do not respond to stress the same way, and increasingly, they are telling very different stories. What's important here is not whether silver goes up tomorrow or pulls back next week. What matters is whether the mechanism of price discovery itself is starting to fracture, and whether the physical market is quietly forcing behavior changes that paper markets can no longer ignore. That's the lens we're using today. No hype, no slogans, no predictions dressed up as certainty, just data, structure, and context. So take your time with this one. Pause if you need to, cross-check sources, and if something doesn't sit right with you, dig deeper. That's the whole point. All right. With the ground rules set and the community checked in, let's move to the first real question we need to ask. Why did two completely different parts of the silver ecosystem flash the same signal on the same day? And why does that matter right now? That's where the real story begins. Now let's get into the event itself, because this is where things stop being interesting and start becoming structurally important. On the same day, two signals emerged from opposite ends of the silver market, one from the paper, institutional side, one from the physical, real-world supply chain, and they were saying the same thing. First, let's start with the paper side. Citi, formerly Citigroup, one of the largest and most deeply embedded institutions in global derivatives markets, raised its 0-3-month silver price forecast by 50%. Not 5, not 10, 50, from $100 to $150 per ounce. Whether you agree with price targets or not is almost irrelevant here. Large banks don't publish numbers like that casually, and they certainly don't do it in a vacuum. These forecasts are not marketing pieces. They are risk management documents tied to exposure in futures, options, structured products, and client positioning. When a bank like Citi moves a short-term forecast that aggressively, it's not because they feel bullish. It's because the distribution of risk has changed. Volatility expectations, tail risk, and the cost of being wrong are no longer symmetric. That's signal number one. Now here's where things get unusual. On the same day, Bloomberg published comments from James Emmett, CEO of MKS PAMP SA, one of the largest precious metals refiners and distributors in the world. This is not a commentator. This is not a strategist. This is someone sitting directly in the physical flow of metal, dealing with miners, mints, wholesalers, sovereign buyers, and industrial clients. And his language matters. He describes silver demand as immense, and not just strong, but unprecedented, in a way he said he has never seen before. He explicitly referenced retail and wholesale orders, overwhelming supply, massive ongoing flows into India, and something that should immediately get your attention if you understand logistics. Silver is being air freighted, not shipped by sea. That does not happen unless time is critical. Air freight is exponentially more expensive than sea transport. You don't do it to save a few days unless the buyer cannot wait, because a production line is at risk. A contract must be fulfilled, or inventory buffers are already gone. This is not speculative hoarding. This is urgent demand colliding with constrained supply. Now here's the dislocation. If physical silver is so tight that refiners are rushing metal through air cargo, and if institutional banks are simultaneously lifting short-term price risk estimates aggressively, why does the broader narrative still treat silver as if it's just another volatile trade? Why does paper pricing still pretend the market is deep, liquid, and easily supplied? That's the fracture. Paper markets are still behaving as though silver is abundant and infinitely rehypothecatable. Physical markets are behaving as though every ounce matters and delays are unacceptable. Those two realities cannot coexist indefinitely. This is where you need to slow down and think structurally. The futures market sets the reference price, but it does not mine silver. ETFs create shares, but they do not refine metal. Derivatives clear on screens, but they cannot satisfy an industrial buyer who needs delivery this month, not cash settlement. When stress shows up first in logistics, shipping methods, delivery urgency, regional flows, it almost always precedes stress in price discovery. And the geographic element matters here. India is not buying silver because of a chart pattern. India buys silver because of fabrication demand, cultural use, solar deployment, and long-term savings behavior. When flows into India accelerate during already tight conditions, that metal is effectively removed from Western circulation. So ask yourself this: if silver inventories were truly comfortable, if supply chains were functioning normally, if futures markets were adequately backed by deliverable metal, would refiners be scrambling? Would buyers be paying premiums for speed? Would banks be repositioning short-term risk this aggressively? Or would none of this be happening? Dislocations don't announce themselves with headlines like "the system is breaking." They show up as inconsistencies, things that shouldn't be happening together but are. And when both sides of the market, paper risk managers and physical supply operators, start flashing the same warning at the same time, that's not coincidence. That's pressure. The question is not whether silver pulls back next week or spikes tomorrow. The question is how long paper pricing can remain dominant when physical urgency is escalating underneath it. That's the tension we're dealing with. And it's why the next section matters far more than any headline number. Because now we need to look at the data inside the system itself, inventories, delivery capacity, and the actual mechanics that sit between paper promises and physical reality. That's where this either holds together or doesn't. Now, we move away from headlines and commentary and into the plumbing of the system, because this is where paper narratives either hold up or start to fail. Let's begin with the futures market, because that's still where global reference pricing is set. On COMEX, silver inventories are divided into two categories: eligible and registered. Eligible metal meets exchange standards, but is not committed for delivery. Registered metal is what can actually be delivered against futures contracts. That distinction matters because only registered ounces can satisfy delivery. Over the past cycle, what we've seen is a persistent drawdown in registered inventories, even as open interest remains elevated. In plain terms, the number of paper claims has not fallen nearly as fast as the pool of metal that can actually be delivered. This creates a leverage problem. When open interest rises or even stays flat while registered inventories decline, the coverage ratio deteriorates. More claims, fewer deliverable ounces. That doesn't mean default is imminent, but it does mean the system becomes increasingly sensitive to delivery preference instead of cash settlement. And that sensitivity is exactly what we're seeing. Delivery notices have remained elevated relative to inventory, and roll behavior has become more aggressive, a sign that some participants are being incentivized not to stand for delivery. Again, that's not collapse, that's stress management. Now let's layer in the commitment of traders' data from the CFTC. Commercials, the entities most closely tied to physical hedging, have reduced net short exposure during periods of rising prices rather than increasing it aggressively as they often have in past cycles. At the same time, managed money has expanded long positioning, increasing volatility, but also exposing how dependent price discovery has become on financial flows rather than physical availability. That imbalance matters because when volatility spikes, leveraged participants can be forced out. But physical demand does not liquidate. A solar manufacturer doesn't stop needing silver because RSI is overbought, which brings us to the global physical markets. The Shanghai Gold Exchange, which operates on physical delivery, continues to show strong turnover and premiums during periods when Western paper prices stall or retrace. That divergence is critical. It tells us that price weakness in futures is not being confirmed by reduced physical interest in Asia. India shows a similar pattern. On the MCX, silver pricing and import behavior reflect persistent demand even at higher price levels. Imports have remained strong relative to historical norms, and local premiums have not collapsed, suggesting buyers are absorbing higher prices rather than backing away. This is not how speculative demand behaves. Speculation is price sensitive. Fabrication demand is volume sensitive. Now let's talk supply. According to data aggregated by the Silver Institute, global silver supply remains structurally constrained. Mine output has not recovered meaningfully relative to demand growth, and a large portion of silver production is byproduct supply, meaning it depends on base metal mining economics, not silver prices. That's a critical limitation. You cannot simply turn on silver supply because prices are higher. If copper, lead, or zinc projects aren't expanding, silver supply does not respond linearly. Recycling helps at the margin, but it does not fill structural gaps, especially when demand is coming from sectors like solar, electronics, EVs, and defense applications that require high-purity silver. Now connect that back to what we discussed earlier. When refiners report that wholesale and retail orders are overwhelming supply and that metal is being air freighted to meet deadlines, that lines up with what the inventory data suggests. There is very little slack left in the system. Paper markets can absorb stress temporarily by expanding leverage, increasing volatility, or encouraging cash settlement. Physical markets cannot. They clear only through metal. And here's the key point that often gets missed. As long as futures markets remain liquid, they can suppress signals of scarcity through price action alone. But once physical tightness forces changes in behavior, shipping methods, delivery urgency, regional premiums, the paper market loses its informational advantage. At that point, price discovery starts migrating, not overnight, not cleanly, but structurally. This is why geographic arbitrage has become more visible. Metal flows eastward, where buyers are willing to pay premiums and take delivery, while Western markets rely increasingly on paper instruments to maintain the appearance of balance. That works until it doesn't. The silver market doesn't need to run out of metal to break. It only needs enough participants to prefer physical certainty over paper convenience. And the data increasingly suggests that preference is spreading. Which brings us to the next piece. Even though fundamentals are doing most of the work here, we also need to briefly address the technical backdrop, not as a trading signal, but as confirmation that multiple layers of the market are starting to align. That's what we'll look at next. Before we step back and connect the macro dots, it's worth spending a moment on the technical picture, not because charts drive this thesis, but because they help us understand how different classes of participants are reacting. This is not trading advice. This is context. On a higher time frame basis, silver has already completed what technicians would call a golden cross, where longer-term moving averages have turned up and crossed above slower ones. Historically, that does not mark tops. It tends to appear after a trend has already changed character. Momentum indicators like RSI have remained elevated for extended periods without fully resetting, which tells us something important. Pullbacks are being bought faster than in prior cycles. That's consistent with strong underlying demand, not just speculative excess. Volume profiles also show expanding participation on up moves rather than thinning liquidity. Another sign that this isn't being driven by a single cohort. When volume expands with price, it usually reflects broader acceptance of higher valuations, even if volatility increases. If you look at longer-term moving averages, price has spent increasing time above them, with shallower retracements relative to past bull phases. That suggests dips are being treated as inventory opportunities rather than exit points. From an Ichimoku perspective again, only as a competence check price has remained largely above the cloud on higher time frames, with the cloud itself thickening. That typically reflects trend persistence, not exhaustion. Now, none of this means price can't correct. Silver is volatile by nature, and technical overshoots can and do unwind violently, especially when leveraged players are involved. We've already seen that during recent swings. But here's the key point. The technical structure is not contradicting the physical and fundamental data, it's aligning with it. In past cycles, you often saw a disconnect, strong charts with weak physical demand or tight physical markets with technically weak price action. Right now, those layers are moving in the same direction, which is rare and usually transitional. That alignment doesn't guarantee anything, but it does tell us that different market participants, from momentum traders to long-term holders, are responding to the same underlying pressure, even if for different reasons. And that sets the stage for the most important part of this discussion. Because when you step back and connect the dislocation event, the inventory data, the physical logistics, and even the technical backdrop, a single macro question emerges, one that has nothing to do with day-to-day price moves. That's where we're going next. We're going to pause, reframe everything we've just covered, and articulate the core structural thesis that ties it all together. This is the why it matters moment, and it's mandatory to understand before you take any conclusions away from this setup. Now let's take a brief look at a technical snapshot. I want to be clear, this is not trading advice. These visuals and indicators are simply a way to understand how the structural pressures we've discussed are reflected in market mechanics. Think of it as confirmation of the stress, not a signal to act. Starting with gold, the Relative Strength Index, RSI, on COMEX futures is hovering in the mid-50s. That isn't extreme, but it does suggest that the market is digesting latent tension. RSI measures momentum, and values in this range indicate balance with a slight tilt toward accumulation, consistent with physical demand exceeding paper market liquidity. Looking at moving averages, gold is holding above both the 50-day and 200-day averages. This tells us that intermediate and long-term trends remain upward-leaning, reflecting steady accumulation. Again, this isn't a recommendation to buy. It's a reflection of how the market is structurally absorbing stress. Crossovers or deviations here are points to watch if paper markets begin to reconcile with physical shortages. The Ichimoku cloud offers further insight. Gold futures are trading near the upper edge of the cloud. In Ichimoku terms, this shows that short-term momentum aligns with longer-term trends, a subtle confirmation of underlying systemic strength. The cloud also highlights potential support zones if volatility spikes, exactly the kind of environment we are seeing. Volume profiles add another layer. Gold futures show concentrated volume clusters around current price levels, suggesting that institutional players are actively positioning. When volume clusters coincide with tight physical inventories, it's a strong signal. The paper market is reflecting systemic tension without fully repricing. This nuance is often missed by casual observers who only watch headlines. Now let's consider silver. The RSI for silver is slightly higher, around the mid-60s, indicating closer to short-term overextension. That aligns with the volatility we expect when industrial demand intersects with tight deliverable supply. Silver's 50-day moving average has recently crossed above the 200-day moving average, a classic golden cross. Again, not a buy signal, but a structural marker showing market positioning for potential repricing. Silver's Ichimoku cloud shows the price trending above the cloud, supporting the notion that short-term momentum matches medium-term scarcity. Volume profiles reinforce this. Liquidity is concentrated at key price points, coinciding with physical premiums in Asia and industrial demand in Europe. This highlights the real divergence between paper markets and physical supply. Volatility metrics are also rising. Both gold and silver futures show increasing implied volatility, reflecting the market's anticipation of potential shocks without immediate repricing. Combined with inventory tightness, industrial demand, and geographic arbitrage, The picture is clear. Systemic stress is building, and technicals reflect that underlying tension. To summarize this snapshot, gold RSI mid-50s, steady accumulation, balance, gold moving averages, upward-leaning trend, structural support, gold Ichimoku cloud, momentum aligned with longer-term trend, gold volume profile, institutional positioning, paper market absorbing stress, silver RSI mid-60s, higher short-term tension, silver golden cross, market structurally positioned for potential repricing, silver Ichimoku, and volume. Physical demand alignment, liquidity concentration, implied volatility rising, market pricing in potential shocks. The key takeaway: technical tools confirm what the fundamentals already show. Markets are not being hyped artificially, they are reflecting real-world tension between physical scarcity, industrial demand, and paper market positioning. This snapshot is a subtle but critical layer. It reinforces the idea that these pressures are real and measurable, even before prices fully adjust. The next section will pause and reframe all the data into one coherent macro thesis, linking debt stress, liquidity, and the growing strategic importance of gold and silver. This is where the aha moment crystallizes. We're going to pause, reframe everything we've just covered, and articulate the core structural thesis that ties it all together. This is the why it matters moment, and it's mandatory to understand before you take any conclusions away from this setup.